Hello, everyone, and good morning. Welcome to our DAT IQ Weekly Market Update. This is our update for September 28th, 2021, our last update of September. I'm Ken Adamo, Chief of Analytics here at DAT, joined, as always, by Ned Damon, who's our Principal Data Scientist, Dean Croak, who's our Principal Industry Analyst, and we have a very special guest this week. We are joined by Tim Gagnon, who is Vice President of Data Science and Analytics at C.H. Robinson. Welcome, everyone.
Morning.
Good morning, Ken.
So we have a lot to talk about, but first I want to give Tim the floor here a little bit to talk about his role and a little bit of his history at Robinson. Tim?
Yeah, thanks, Ken, and really appreciate the opportunity to join you guys here this morning. So 22 years with Robinson and seen a lot happen in this industry for sure, and probably nothing more chaotic than the last couple of years. But as you mentioned, I lead a team of analysts and data scientists kind of navigating our information landscape and the data, kind of created from the many shipments that we execute, but also as well a lot of macroeconomic data and data that comes from great sources like DAT. So again, happy to be here. Looking forward to joining the discussion.
And again, thanks for coming on. We truly appreciate it. And I guess just in general, to make sure that we don't exit the show without saying it, we're super grateful for the partnership we have with C.H. Robinson. It's just when two folks in the industry, two sort of industry leaders can come together and make really cool things happen. I think they call that a tease of what we're going to talk about later in the show. But it's just great, right? Thought leadership, sharing of data, it's all really good and positive transparency for our industry. So with that, we're going to do an abbreviated version of our market update this week because we want to save a ton of time to talk about Market IQ and all of the cool things that Tim has to share later in the show. So we're still going to do the typical items. We're just going to speed through them a bit. And with that, if you have any questions for us, as always, but for Tim specifically around Market IQ or any of the things coming out of Robinson's Data and Analytics shop, please drop them into the comment or chat section. We expect having a lot of questions this week. So if you can get those in early, it gives the best chance of those to be answered. So with that, I'm going to quickly touch on our key points of the week. So what do we have going on? Oh, yeah. All-time high for dry van, and been that way for going on 3 weeks now. When you strip fuel out, we're still above that 250 a mile range. As we head into peak, we all know what's happening with the ports. Things continue to be extremely tight there. Reefer rates cooling a bit, and some interesting things going on in flatbed. I think those are better expressed in chart form, so Dean will touch on that. LA to Chicago, major bellwether lane, new 12-month high. Absolutely crazy. I would say this is the number one lane we get a lot of inbound questions on. And looking through some of the raw data this week, it is crazy. Not just the level, right? The dispersion, the way that the data looks coming in, the lumpiness of it, it's just wild. Contract rates continue to rise with no real end in sight. ATA's truckload index was up 0.5 point in August. And then produce volumes, just kind of as you would expect, 29% since July 4th. But continuing to hold strong on a week over week. And again, get that guacamole going because fall Mexico avocados increase 31% week over week. So with that, turn it over to Dean to get us through the market update.
Yeah, thanks, Ken. All right, let's start off the market update with our load board activity in the dry van section. Load post volumes were up 2% last week, still down 10% month over month, though. So still a downward trend there, albeit slowly. Equipment posts were up 1%. Combined effect on the load to truck ratio was it moved up ever so slightly from 5.96 to 6.17. In the refrigerated load board activity market, volumes increased 2%. Equipment posts were up 7%. That pushed the load to truck ratio down slightly from 13.55 just to 12.95. And in flatbed, the load to truck ratio increased for the third week in a row. There was a 7% week over week increase in load post volumes. As a result, the load to truck ratio increased from 46.85 to 50.38. Wrapping up some of the market activity on our market condition index in dry van port markets based on import volumes. They made up 4 of our top 5 markets last week. No surprise, Los Angeles and Ontario were the number 1 and 2 ports. Elizabeth, New Jersey and Philadelphia were 3 and 4. Atlanta number 5. And Port Watch this morning, 67 vessels at anchor, 44 physically anchored, and 23 drifting in the wind, as the experts call it. As Ken mentioned, volumes are up 12% week over week in Los Angeles and up 10% week over week out of Ontario. That translated to a 12% week over week on the Los Angeles to Chicago line. This morning in Savannah, also congestion, 27 vessels waiting at anchor on marine traffic. They're waiting on average 7 days. Savannah outbound volumes up 17%. And in the flatbed market, the refrigerated market, as Ken mentioned, lots of activity on the southern border. Truckload volumes were up on the produce market 14% last week. Lots of avocados coming across the market. Most of the volumes coming through McAllen and Laredo. Capacity was a little bit tighter, only moved up 1 penny per mile to 226. Overall trend is still down, though, as Ken mentioned. In other news, the New England cranberry harvest is underway. Capacity's always been tight here for most of the year in the refrigerated market, according to our local shippers in the food industry. So capacity will tighten a little bit more. Volume was up 8% last week in the spot market. Spot rates were up 4 cents to $2.53, excluding fuel. Capacity's tightening again in Twin Falls, Idaho. Rates are up for the 4th week in a row. Ended last week at $3.12. And in the flatbed sector, lots of volume coming out of Lakeland. They've been climbing for the last 5 weeks. Even though outbound rates remained flat at $2.23 a mile, capacity was tighter on the lane from Lakeland to Atlanta. It was up 15 cents a mile over the August average to $1.83. And heading west from Lakeland to New Orleans, which is still recovering from Hurricane Ida, rates were up to $2.05 last week, which is 24 cents a mile higher than the August average. Having a look at our year-over-year look at spot rates in the dry van sector, since Labor Day, dry van spot rates have plateaued at just over $2.50 a mile. Been sitting around $2.50, $2.51 for the last 3 weeks. Almost no change last week, ending the week at just under $2.51. Compared to the same week last year, rates are still 13% or 33 cents a mile higher. In refrigerated, following 5 weeks of gains, the reefer spot market cooled off last week. National average spot rate dropped by 2 cents a mile to an average of $2.85, excluding fuel. That's 51 cents a mile higher than this time last year. And lastly, in the flatbed sector, it's continued to oscillate again last week. Spot rates up 1 week, down the next. Last week, they moved up by a penny per mile. Following the week prior's decrease by the same amount. They ended last week at $2.66 a mile, excluding fuel, still 17% or 46 cents a mile higher than the same week last year. And compared to 2018, flatbed rates are still 52 cents a mile higher. So that's it for this week's abbreviated market update. If you'd like to find out more, have a look at our long form market update. Go to dat.com /market update and download our weekly report. And that's it for the weekly update. Over to you, Ned, for the short-term forecast.
All right. So in the short-term forecast, again, we're going to try and breeze through it. We're going to start off with dry van. In blue, you can see the market rates observed by DAT, and then off to the right, you can see our forecast. In red, our short-term forecast is expecting rates to continue to rise by about 5 cents heading into the end part of October. Our ratecast forecast is expecting things to remain about the current level and then a drop as we head into the middle and later parts of October by about that same amount, 5 cents. And the two blended forecasts are leaning a little bit more towards the ratecast forecast than those are in gold and silver, and expecting levels to stay about the same or drop a couple of cents. Moving forward to reefer. Pardon me. Once more in blue, you can see the market rates observed by DAT. And here there's pretty big model divergence. In red, you can see the short-term model is expecting things to continue up and to the right very strongly, moving up by about 7 to 8 cents as we head into the middle part of October. The ratecast forecast is expecting things to hold for about a week and then start dropping a total of, I'd say, 3 cents of motion, 3 to 4 cents of motion, moving into the middle part of October. And then the blended forecast leaning more, in this case, towards the short term and expecting a little bit of gain, but overall a relatively flat pattern. Finally, in flatbed, we can see once more in blue the market rates observed by DAT. And then there's here broad model agreement between the various models. The short term and ratecast are expecting rates to drop by about 2 cents on a very sort of slow, gradual slide moving into the middle part of October. And the blended forecasts are, of course, expecting basically the same thing to happen. And that's it for the forecast. Now on to the IQ question of the week, which is, What's the outlook? No, that is not the IQ question of the week. Tell us more about, that's an old IQ question of the week. What can you tell us about market IQ?
So for that, we're going to, just to level set everyone, we announced in partnership with C.H. Robinson collaboration on a new sort of market analysis tool that C.H. Robinson was working on. Like I said earlier in the show, we're thrilled to be part of it. And we thought there's no better way to explain in a little bit of a longer form what it's all about and what some of the benefits are than to have Tim on the show and walk our listeners through it and answer some questions about it. So with that, I'll turn it over to Tim to walk us through.
Yeah, thanks, Ken and Ned. So just kind of a quick hitter, top of the house on market rate IQ, and I look forward to kind of diving in to the extent that the questions take us. Obviously we talked at the opening, and you just kind of gave some great information on what's going on in the market. It's volatile. It's been volatile, and one of the commitments that we have is, really to try to help our customers navigate, and carriers, of course, through, these difficult, challenging markets that have sustained themselves for many quarters now. So as, we started working really a couple of years ago on just new ways to try to navigate the transactional marketplace, the spot market, and, trying to move from just having these type of insights where we understand some of the trends in available capacity and pricing, to trying to take some actions, try to help our customers with tactics to try to contain the cost. I mean, it's hard to reduce the cost in a market like this, but certainly contain the cost and try to make good decisions really in real time, if at all possible, to try to really, again, navigate this difficult market. So, that's something that's consistent with what we've tried to do for a long time, is helping our customers through challenging markets and, trying to improve their outcomes, their spend, their service. So this product was born on that premise, very consistent with what we've tried to do for a long time. And the partnership with DAT has really, I think, made the product a lot more powerful, because we can not only take, the insights that we can glean from our own information, that obviously we've got a lot of granular information on millions of shipments in the truckload space that we can gain a lot of insight and benefit from, but also obviously the density and scale of the DAT data as well. So it started with a customer, and then a couple of customers, and then a couple dozen customers, and we felt like, there's a lot of benefit being gained from the collaboration and the transparency that we were able to put together in this product. And as you said, Ken, last week, we kind of went, what I'd call to a more scaled product delivery inside of our platform, Navisphere, where we now provide access to this product to all of our customers, executing through a digital spot freight environment. And it's been really exciting. Just in the less than a week since we've kicked this off, we've got a bunch of activity, and we're on the path to really trying to help more and more customers through this journey. A little bit of how it works. It's a pretty straightforward premise of, when we're executing spot freight, to be able to understand the attributes and characteristics of those tenders and look for opportunities to try to contain or minimize or reduce cost, if at all possible. And that can be based on lead time characteristics, the day of the week it's shipping, a variety of things, but also then to be able to benchmark that rate of the Robinson quote, if you will, the Robinson tender versus the DAT benchmark, to give customers even additional insights as to, what is the outcome of that particular transaction, and then be able to aggregate that to an overall relationship that we have, but also slice and dice it through shipping locations, delivery locations, geographies, et cetera. So I'll leave it at that, just to kind of give a top of the house on what the product's allowing us to do. Again, we've been working on this for over a year now, and have a couple hundred customers engaged in it, and looking forward to continue down the path of working with our customers to try to help them navigate what, our forecasts are similar to what Ned had portrayed here and has been talking about, not just this week, but for some time now, that we do expect that things will likely persist through the fourth quarter this year and on into 2022.
Yeah, for sure. I think so. Just real quick to put out a call for those who may have joined us a little late. Please drop your questions in the comment or chat below. Anything about Market Rate IQ that we can help kind of navigate through, we're more than happy to talk about on the show. So go ahead and do that. But just selfishly, since I'm the host of the show, I'm going to ask my question first. So it's been a huge area of study for us at DAT. And the way we think about it is there's a lane rate, right, which has historically been what we use, think Atlanta to Chicago. And that's been great, right? Because holistically, it's nice to know what all traffic moving on that lane looks like. And then historically, right, you'd use your experience to thumb it up or down, depending on whether it was hazmat, lead time. I'm curious from your perspective, like, how do you think about, like, what was the impetus for you guys to think beyond just the Chicago to Atlanta rate, to think more about, because that's to me, the coolest view in this tool is the way that it's Paretoed out, that these are the main factors driving the rate up or down. So what was that real impetus for Robinson to start thinking beyond just the lane rate and really getting into shipment specific rating?
Yeah, well, and this isn't necessarily a new insight, if you will. And I know you guys, we've talked a lot about it and shared this. I mean, the variability from geography to geography, the seasonality or time of year, the attributes associated with shipments all have a really significant impact. And we've worked on the average of averages for some time, when that's the best you can do. And while it's always good to have insight, if you can get down to a deeper grain, you feel a lot more confident in, and you actually can see the benefits associated with a much more granular view. So to your point, Ken, we've been very intentional about being able to deliver that granularity, whether it is aggregating to looking at a week at a glance or a particular shipment in a moment in time with all the various attributes associated with it. It's very valuable. And what I mean by that is if you look at even a geography in a very broad sense, it's beneficial to break that geography down to the lowest common denominator to the best of your ability, whether that is the attributes of the freight, the type of equipment that's going to be used on that shipment. All of those things are critically important, and we're able to kind of navigate through that and slice and dice at the speed of thought, if you will, to try to get to the type of learnings and outcomes that help drive better outcomes.
Not to take up too much more of the time with us asking selfish questions, but something that you mentioned that I think is really interesting is talking about finding ways to use the tool to help control costs. So you're actually, can you give some advice for people who have access to a tool like this or to your tool about if you see that the rate is likely to be much higher than you'd care for, if you're on the broker side, what you can do to help control your costs?
Yeah, I think that the key is timing. I think as an industry, we've struggled with being able to get information to the right place at the right time, meaning that we're often looking far in arrears of what has happened. And while there may be a valuable learning there to benefit you for future decisions, there's a missed opportunity in the moment of a decision that you could make to try to maybe persuade your decision to get to a better outcome. So one of the real important factors is to try to get to as much real-time decision making as we possibly can, and for ourselves as a provider to our customers, but also in the customer's decision-making process. The number one attribute, and there's a lot of different attributes that influence outcomes in the spot market, of course, but the number one attribute in terms of what is a premium or being subjected to higher rates is lead time. And obviously, if we can identify those lead time premiums at the time of the tender and try to navigate a discussion or a notification even of, hey, is it possible to wait a day on this, wait 2 days on this, and here would be the outcome. sometimes a shipper's tenders, they are able to, and we've actually been able to get to, instances where it is possible to change the shipping date associated with the tenders, and that leads us to optimized outcomes. So there are many other opportunities, but lead time is one primary category that we've been able to see or kind of steer different decision making at the time of the tender that I think is something that not only in that moment is a good opportunity, but then we're able to start to learn how often is this happening? Can we start to steer the logic in our systems to produce better outcomes for future shipments as well? So it's been pretty exciting to see some of those things play out over the past year, and we know that that'll continue to happen.
For sure. So before we jump in, I have a couple more questions that I'm curious about. So C.H. Robinson obviously moves a lot of freight. This isn't news to anyone listening, right? They've been at the top of that transport topics list for as long as I've been in the industry, right? The top brokers. So why was it important, Tim, for your customers, and it sounds like you did all of the steps, classic product development, right? You had a few customers interested, you built upon that. It sounds like you built this in strong collaboration with your anchor customers. Why was it important to have sort of that external market benchmark view in there as part of your product development process?
Yeah, there's several reasons, really. I kind of hit on the top couple. One, while most folks know Robinson's scale and density of our information, even as large as we are in the number of shipments we move, we still would portray ourselves as less than 3% of the overall trucking market, and therefore, just by the nature of how fragmented the space is, there can be bias in the data that we're presenting in terms of some of the things that I've been talking about already. So leveraging the scale and density of DAT's information gives us, additional perspective to share with our customers, but also learn from ourselves, which we've been doing obviously for years and years as well. The second factor that I would mention is, and this is no surprise to anyone probably tuning in, is there's more and more automation in our industry today, and we have a higher and higher percentage every month of the share of our tenders, transactional tenders, that are happening in an automated forum. So it's a system-to-system process that's got a set of rules, and if those tenders come to Robinson, we're executing that tender, and that'll be executed based on our transactional pricing engine, what we call TPE. And the DAT benchmark gives us the opportunity to share with customers, here's the rate we provided for you on that tender that happened in an automated forum and fashion, and we can reflect on, how that tender compares to the marketplace. And, it's a very transparent scenario. One of the very top of the house benchmarks or metrics, I should say, is what is your spend versus the DAT benchmark. So they're very transparently able to see the outcome of their Robinson spend versus the DAT benchmark in all of those lanes, whether we're under the market, over the market, whatever it might be, we're typically under the market. And then we also provide the granularity of the deconstruction that I've been talking a little bit about,
right.
Days tendered, et cetera, et cetera. So those are the couple of top of the house attributes. We also very much use the DAT information in our modeling, in our forecast, in our transactional pricing engine as well. So I can get into many other factors that are down grain into what I'll call the analytics and science operations. But those are, kind of the features within Market Rate IQ that our customers have valued.
I'm sure some of our listeners would be a fan of that, present company included, but I'm not sure that would be the best way to. I think we'd see some folks drop off. No, I think it's really cool. Right? I mean, we think about things as from our side of the table, right? I just pulled it yesterday just for something I was working on, and historically, if we look at just legacy rate view, we have like $500 billion worth of freight transaction value in the database and hundreds of millions of transactions, and it's just. The reason I bring that up is not to kind of toot our own horn, but just to think about, we've been doing this for a long time, and it's still fun to see new ways to leverage the data, to deploy it. and to find new uses for it. And one question we had come up that I know a bunch of folks wanted us to ask, but I don't know if it came up in the chat, was, to be clear, I mean, you're not just kind of regurgitating the rate view rate within the tool, right? It's kind of done in a way where it's more of a variance to benchmark, kind of like a market rate average, right? Can you just talk real quickly about sort of that external market perspective and how it's being used in the tool?
Yeah, yes. To your point, it's being presented as a very generalized market rate, although it is, available down to the load level. Obviously, the DAT data is anonymized. We get no detail of the source of the information, which we value. But yeah, we position the rate at an aggregated summary, or the benchmark at an aggregated summary level of the total, what would be the DAT rate view rate times the number of shipments. So it's a spend amount versus the Robinson spend amount. And that's available at that summary level and all the way down to the lane level. Kind of hard to help the viewers visualize what that looks like without showing within the application, but it's a couple of clicks away. But yeah, it's very much so. For those folks that know RateView and using the product, you get just a very general perspective on the rate, and then we use that really at the shipment grain and roll it up to whatever perspective you can filter on: the week, the month, the day, within the tool to be able to aggregate the information.
Cool. Thanks for that. Like I said, I know it was on my mental notebook of things to bring up. So that was a great overview. I think maybe we should pivot a little bit back to actual user or listener.
I was going to say,
so selfish.
We got a lot backed up. First Row Logistics asks, interested in your thoughts regarding the potential debt limit shutdown. Is there going to be an impact on the industry if it happens?
And Tim, feel free to jump in on any of these.
Yeah.
I'll take a pass on that one. I'm not going to.
Luckily, we have Dean.
Yes.
Yeah, I'm taking a pass on that one too. Sorry.
I mean,
so I can speak to a little bit, right? So I was in the industry whenever the last time this happened, and I mean, a lot of the DoD freight, a lot of the GSA stuff. I mean, they're not. A lot of this stuff does shut down the non-core services of the government, so I think that could have an impact. It caused some backlogs, some things like that. Who knows in the midst of COVID? I don't even remember when the last big fiscal cliff and all that stuff was. I'd have to think back. But the market wasn't as crazy as it is now. So any disruption, no matter how small, is going to have amplified impact at the moment, I would say, for sure.
I mean, it's going to have less impact than it would have on air freight, though, which is going to force some mode share switches.
This was all ground freight. I mean, sure, there was some air traffic control stuff that was impacted, but what I'm talking about mainly was like sending and like the consignee and the shipper being impacted if they were government entities.
All right. I mean, I think the bottom line is it's bad. It ought not to happen.
I mean, preferably we prefer the government not to shut down. Just as if DAT had an outage, we would prefer that not to happen, or if C.H. Robinson was unable to cover a shipment, I'm sure Tim would prefer that not to happen. We would all prefer our elected officials to do their jobs. I think that's a very apolitical statement.
Hakeem Jones, how about cargo vans? How about them cargo vans? I mean, I feel like we've covered a fair amount of dry van stuff, but hopefully we can get more information about that question, specifically what's in context too. Stephen Pettit asks, does CHR... all right, sorry. Moving forward. Abdurrah Mata, how can I search the national load counts for straight box truck?
So I think you go in for partial, and you can enter your. It's been a while since I've been on the other side of the desk. I think you can go in and put your length and your weight and your select it as a partial, and do it that way. So if you need more help, I mean, you can go ahead and open up a chat or reach out to our customer service folks, and they'd be more than happy to walk you through that. We're seeing a lot more of this, right? We're seeing a lot more partial truckload. So let's just talk a couple things. It's coming from multiple directions, right? You're seeing this offshore capacity where you can transload 1 TEU into a 28-foot. I mean, depending on how Dean, jump in here. I don't want to make sure I'm not getting too far astray, but in theory, depending on how it's loaded, you could take the contents of a 1 TEU and get it into a 28-foot box truck or even a partial truckload. And then you're seeing the fall down from LTL being unable to keep up, especially on the priority side with the volume that they're seeing. That definitely is a strong candidate for partial. And this is something we did see in 2018 and in 2015-16 on those tight capacity environments. When I was in the industry, was a strong uptick in partial as a pressure release valve for LTL and some of the inland intermodal moves. But Dean, you're far more.
No, I think you're right. There's certainly a lot of that lightweight retail freight will certainly be moving in those 28-footers. Ken, as a backup, a lot of that hot shop type freight.
Yeah, it is. And I think too, though, they call it like zone skipping or whatever. So if you're having trouble with your LTL and you want to inject it into a different hub in the hub and spoke network, a lot of times they'll use 28-foot. But I mean, there's just so much that goes on in the straight truck space, right? They just removed, a couple of years ago, they changed the tax regulations around the excise tax for having a tag axle. So some of these big 28-foot straight trucks can only haul like 3,500 or 5,000 pounds. They're very expensive. A lot of people get into these box trucks to haul like DOD freight, the sleeper big straight trucks, right? So they're kind of retired. Instead of buying an RV, this is at least revenue generating. So those are things. It's a very complicated market. So yeah, go ahead. If you reach out to our customer service from the mechanics of posting, but if you have questions about the market in general, we can file that away for a future show to kind of dive into more depth.
Yeah, we get a lot of those questions, and I think we really ought to do a show coming up on straight truck, box truck, hot shot.
Right.
Does CHR contribute to RateView? What's the relationship between RateView and Market IQ?
Yeah, so CHR does contribute some of our data to RateView, and that's been a long-standing relationship. Ultimately, Robinson's data is a very small percentage of RateView if we do the math right. And I think
which we do.
Pretty aware of it. So we do feel like it's a very credible source, and we realize that some of our data can influence that data just based on the fact that our data is in there, but it's still a very small percentage of the total. So it's that influence is generally muted, but yeah, we do contribute.
So the reason, just for our listeners, the reason why we want to be very careful when we talk about this and make sure that whether you're the smallest, we have 1,100 contributors to RateView and counting, whether you're the smallest contributor, whether you're the largest, we treat every single one of those contributors with the same care, confidentiality, security. The data is all strictly anonymized, aggregated. I'm not going to get in kind of RateView 101, but there's absolutely no way you could back into who contributes even on a specific lane, right? So if you knew that a certain broker, carrier, or shipper was the only one moving freight on a lane, and you went in and searched that, there's no way you'd see their rates. The math behind the scenes, the RateView algorithm takes care of that in a way that everyone is protected. So yes, we would never come out without a customer's explicit permission and say who or what's in that average. Like I said, it's 1,100 customers. Tim made a great point. It's 100. We're on track right now to crack $100 billion of contributions this year. If you do the math around how big the brokerage industry is, what percentage is contract versus spot, you can kind of back into, there's a lot of contributors in that database, but you'll never see us out there talking specifically about who's in there without the express permission, because this is not who we are, right? That would betray the trust of our valued partners.
And I would mention, Ken, that that's really important to us as well. We have no interest in that detail in the world of data privacy, and in today's universe, it's so important. So it's a high priority for us to make sure that not only for the data that we're leveraging, but also the data we're contributing, that it is very sensitive information and anonymized and protected by DAT, and we trust that.
Awesome.
How much more time do we have for questions? I know we're already over.
Fire a few away.
Okay. Matt Clark is asking Dean specifically. You mentioned a backup of ships in Savannah. I was aware of the backup at LA Long Beach. Will the backup in Savannah prop up rates in the Atlanta market? And if so, any thoughts on how long the increased rates could last due to the port backup?
Yeah, I think, Matt, if I could take this offline, shoot us an email at
Certainly.
askiq@dat.com. I'll do some research on that in the background later today and get you an answer on that one, and then we can maybe cover it next week also on the show.
Yeah, shout out to Matt, huge friend of the show. We did a podcast a few months ago at this point. Yeah, we'll be happy to. He's down in Atlanta, so I'm sure he has very intimate concerns about what's happening in Port of Savannah.
We're getting a lot of questions about box trucks, specifically do we have a box truck forecast? Do we have year-over-year comparisons for box trucks? We right now don't, but we're getting enough questions about this. I mean, not to promise things that I can't deliver, but I can try and jank together some kind of box truck LTL partial thing to give a comparison point on a future show if there'd be interest there.
It comes up every single week.
Yeah.
Tim, I know this isn't your area of the business, and feel free to just totally punt on it, but I mean, is that something you're hearing more chatter amongst your peers? This sort of manufactured, partial business because we're hearing it every single week.
Yeah, yes, we are. And it's something that, I wouldn't say that we've got a scaled answer to that or solution for it, but it's something we're getting a lot of questions from our customers on, and our teams are working on.
Yeah, I mean, one of the problems is it's just so heterogeneous. Flatbed already, you have this problem that there's a lot of micro equipment categories that all get lumped into the overall flatbed space, and that causes your distribution to be kind of goofy.
For sure. All right, maybe one or two more. Maybe the power only question.
Yes, we have First Row Logistics asks, is there a way to compare power only spot rates year over year?
We get this one a lot too, right? Power only is tricky because sometimes it's more expensive and sometimes it's less expensive, depending on if you're building the cost of the trailer pool you're being asked to maintain into that power only price. And maybe I'm thinking about that a different way than you're asking the question. Maybe I'm thinking about that from the view of the carrier pricing it to a shipper. But Dean, do you have any sort of? We could take a look at it and see how much of the underlying data is power only. But I have a feeling it's not going to be noted that way.
Yeah.
Correct.
If we're going to be poking at the box truck stuff, we can try and lump this in and do unusual, non-standard equipment. Break things out. But sorry. I think that's it for questions, unless the Hollis Darren question is something we want to handle.
And it's just kind of the 28-foot box truck question, right? So I think that's just something we'll dig into and maybe follow it up as our question of the week next week, and put some research behind it for sure. So I'm going to start wrapping us up here. So first of all, Tim, thank you so much for coming on. I learned a bunch, and I was behind the scenes the whole time of the new tool. So thank you for being so open and transparent about what's happening there.
Again, thanks again for the opportunity. And, like with any product, it's generation one. Might be fun to kind of come on again a few months down the road just to see how things evolve, because they constantly will. But, as you execute more, you learn more, and products develop and get enhanced. So, obviously you'll be, like you said, you'll be very close to the action to understand what that looks like. And again, I just really appreciate the opportunity to kind of share some of the cool stuff we're doing, not only for our customers and the work we do together, but hopefully try to move the industry forward in a way that we've been challenged for years and years.
How can folks, this show is viewed by shippers, carriers, brokers, and sort of analysts all around. How can folks sort of get in touch with the product managers or account staff that handle the new tool?
Yeah, there's probably the two most immediate ways would be through their account team or their customer representative that they deal with routinely, but also marketrateIQ.com. We've got a website that can take you right in, and you can get access to all the information, and we'll follow up with you directly. So whether it be through your account manager that a shipper would deal with routinely, or directly on our platform.
Awesome. Cool. And again, thanks for being a friend of the show. It was kind of neat. This one of the benefits. Never thought I'd be doing this in a million years, right? Being a data guy, but walking into C.H. Robinson's headquarters a few months ago, and just having that little, almost like that orthogonal introduction through the show, right? It was really cool, and I get that more and more as we do this. So thanks for being a friend. So to wrap us up this week, again, thanks to Tim, thanks to C.H. Robinson. I do think it's cool. I'll sort of end on this note. Two big players in their respective industries could very easily choose to have an adversarial relationship. And I've just been I think that's an endearing quality of our industry. But then also I think it speaks a lot to the leadership at DAT and C.H. Robinson on how we can, of course, draw very clear lines, but also collaborate to bring the industry forward, to be transparent. And I think it's a huge statement to say in transparent markets, everyone wins. And I think if that's one of the big takeaways we can have from this process, that would be an overall positive. So that's really the show for this week. I thank everyone for joining. Dean's market update in full is available on the website, as he mentioned. I know that we sped through some of that. And we will be back next Tuesday at 10 a.m. Eastern to answer your questions and talk more about freight. Bye, everyone.
Bye.
Bye.